Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about the key highlights of what's going on currently. First of all, the crude oil market is trading at around 105.84. Alright, and it's been on an upwards trend on a consistent basis. Now going over to the US dollar index, the US dollar index has been performing relatively softly in the past couple of days, even as oil continues to head higher. So obviously the correlation between crude oil and the US dollar is not playing out right now. And the main reason why it's not playing out is because of the fact that Iran has cut off oil supplies to UK and France, and Iran has also threatened to close the Strait of Hormuz, which is a shipping route that apparently carries 20% of the world oil. Now, aside from those two factors, there's another thing that kind of, that offsets the biggest issue here is the fact that Iran is a huge supplier and producer of oil, and all of its shipping and production is being shifted from the Western Hemisphere all the way to the Eastern Hemisphere, primarily emphasizing China, India, Korea, Japan, and Australia. So that just means that one side of the world economy is getting cheaper, or not cheaper oil, but a larger, more abundant supply of oil, and the other side of the world economy being the Western Hemisphere, being Europe and the United States and the South Americas and Africa, well, not really that much Africa, but primarily the Western industrialized complex, is not getting the necessary oil that it needs from the Middle East, and Middle East is shifting supply to the Eastern Hemisphere. Now, again, the big issue is that the crude oil markets are primarily traded on the New York Mercantile Exchange, and when you have rising oil prices, the biggest issue that comes into play is the fact that higher oil prices means consumers have to pay more for gas, which means they have less money left over to buy other goods and services. The main services and goods that I think will be heavily damaged would perhaps be technology companies, unnecessary fashion accessories, so fashion, retail, primarily a lot of retail, companies that are cyclical in nature, such as Intel, Qualcomm. The chip business will get hurt. Software will probably be impacted negatively as well. You're going to see a lot of automotive companies perhaps not be, perhaps car buyers may not be so willing to buy cars because of the fact that higher gas prices will mean, bigger output costs when buying a vehicle. So overall, you can see a negative impact on the cyclical side of the economy, but the non-cyclicals should be relatively stable, at least from what I'm seeing right now. And let's just review how crude oil futures kind of trade. And the mentality here is that crude oil prices will most likely continue going higher, and that's going to have a negative impact on the gross domestic product, as consumers you can cut back on some of your driving up to a certain extent. But overall, people, when they drive their vehicles, they drive their cars, chances are you have a set schedule, you have to buy your groceries, you have to drive to work, and for everybody who lives outside of the urban area or the urban strait, primarily New York, the Boston area, and stuff like that, for us in the western, the western side of the United States, and even the central United States, is that people typically drive anywhere from around 20 to 30 minutes a day to go to work. And that's an essential task that you really can't reduce much on. Sometimes you can do a little bit of carpooling and stuff, but you're not going to see a real major change in driving behavior. Perhaps maybe around a 10%, 20% difference in consumption, but those patterns will reemerge as people start to cut different areas of their budgets to afford more gas. And that, in a sense, will cause other sectors of the economy to weaken as oil prices continue to go higher. Gross domestic product will be damaged, primarily because, again, when more money is being spent on oil, that generally causes less consumption and occurs on a marginal basis from companies who use oil. Perhaps the shipping companies like FedEx, UPS, those companies will most likely charge a higher rate on shipments. Companies in the retail industry will be hit by a double whammy. One, shipments will cost more, and second, people are going to be less willing to buy as money is going to compete for different resources, and crude oil will be amongst the top of the list, along with mortgages and, of course, utilities and food. Those are going to be your essential areas, and everything else is not going to be as essential to the consumer diet. That being said, let's get back to crude oil. Crude oil is, grinding higher. And let's remember, when people buy future contracts, they assume that at a future point in time, they are going to receive the current price. Now, for anybody that's a gas distributor or people that are retail, that sell gas on a retail basis, those people are most likely going to buy the crude oil futures right now in anticipation of future prices that are going higher. Therefore, you can make a difference in the spread, perhaps at 105. Let's say crude oil goes all the way up to around 115, 120. Well, that difference in $15 makes a huge difference when you're selling millions and millions and millions of barrels a day. Okay. Now, for the producers, though, I don't see producers being in any hurry to sell their future contracts on crude oil because, with all these economic and, not really economic, but political issues coming out of the Middle East, I don't think anybody's going to be in a major hurry. And the main reason is because there's a set supply of crude oil production in the United States. There's only so much offshore drilling that can be opened up. Yes, President Obama came out this past year saying that they're opening up more places to drill off the shores. Issue is a lot of that output has not been produced, and right now Iran is causing a lot of trouble, and basically siphoning off a lot of the Western Hemisphere from at least Iranian gold oil supply. That being said, since oil supply is being limited, but it's a lot of it is just politics. I don't think Iran has been selling much oil to the Western Hemisphere as of late anyway, but it just reemerged as there have been more talks, more arguments in regards to Iran, and of course their threat to close the Strait of Hormuz. I don't even know how to say it right. Okay, so the main idea going forward is that futures traders will most likely buy futures contracts that are going to be buys. There's going to be very few futures sellers going to sell, and since there's a little bit of selling and a lot of buying pressure in the futures market, it's going to be an upwards grind from here. Let's review how futures contracts works. First of all, a future contract is only created when you sell a contract, and when somebody is also willing to buy a contract, and when that same person goes back to sell the contract is immediately removed from the market. Right now, there's a lot of buying pressure, and there's not a whole lot of people willing to sell oil at 105, unless if you're a real oil company. But even those guys, they're just going to sell based on the market rate anyway. Chances are, though, oil companies themselves are going to speculate and perhaps buy in at 105, so they can perhaps buy oil from their local competitors and then turn around and sell it at reserve 105 for a future date, so they can buy 105. And turn around and sell it at 120 or 125 or whatever the price of crude oil may become in the future. So the whole idea here is that oil companies themselves are probably speculating that oil prices will go higher, and because of the political conflict in in Israel and Iran and their whole tish over I don't know really what, but again they have these huge political tensions where they want to kill each other off the planet Earth, and that's not going to bode very well for the oil market because again, that's just another set of issues in the Middle East. More issues in the Middle East where a vast majority of the crude oil is already being produced and a large amount of the oil supply already exists could be bad for both those pipelines, supply lines, and of course the distribution chain, which just compounds the issues of higher oil prices, which again, higher oil prices is negative for the GDP growth of the economy, which all goes back down to the US dollar index, being trading flat. And, when the US dollar index trades flat, that's just because, there might be some implication that inflation is happening because more people are paying more for crude oil. But if you have GDP, deceleration, that also means that your GDP decelerates. That it could also imply deflation, which would mean a stronger dollar trade. And since both factors are balancing themselves out right now, you're seeing the US dollar index trade relatively flat for the past couple of days. And it's a really hard trend to determine where the US dollar index is going to go, primarily because of the fact that Greece also was bailed out just a couple days ago, which might give some confidence in the Euro-US dollar trade. But again, I think everybody was already anticipating Greece getting bailed out, so I'm thinking a lot of people are taking their profits on the Euro-US dollar trade, which could lead to a short-term bounce in the US dollar index, and perhaps it could retest that 50-day moving average area at around $80. Okay, so the main reason here is, again, once you already anticipate an event and it already happens, typically if you're trading based on that event and the event already triggers itself, all the people that were buying into it are now going to be taking their profits off of that event happening. And the main event that happened this past day, I think yesterday or the day before, was Greece getting bailed out. Greece gets bailed out. That means, of course, the currency markets are just going to liquidate whatever profits they've already made. If you're a real smart trader, that's what you'd be doing right now. If you're an amateur, you'd be buying in right now, and I really don't understand why you would buy in after all the hype that's all fizzled out. Dow Jones Industrial Average has continued going higher. It did edge up a little bit above that 13,000 area, but not really that much. I mean, it just poked above it for like, you know, a couple of candlesticks here and there, and then it continued lower, barely close below the session negative, and then it continued a little higher just to close right above the session at a positive close. Now, Dow Jones Industrial Average has been on a consistent uptrend for the past couple years. A couple years, but also the last couple months as well. You know, this goes back to that trend line I was pointing out from the top of the 2007 area. Again, you know, we could see a market pulling back a little bit. The whole idea here, though, is that, again, too much buying, not enough selling. Markets eventually have to give back some of those gains, and it has to do it at some point in the future. The perfect storm to do that right now is the whole entire Iranian issue, gas issues, you know, stock, you know, the earnings have already been released. People should be taking their profits by now. The Euro-US dollar trade, people should be taking their profits right now. That should lead the the US dollar index basket to go up. That should also cause the basket of risk assets to go lower as well, including the Dow Jones Industrial Average, albeit a lot of what's on the Dow Jones Industrial Average is not cyclical. But at the same time, I have to admit Dow Jones Industrial Average should be giving back some of those gains just because people are going to be profit taking off the Euro-US dollar. And not only that, earnings are already over. So that's a double whammy right there. Moving on, the Euro-Japanese yen has been on a pretty upwards, it's been on a pretty consistent upwards trend as the Bank of Japan has consistently decided to fight off this deflationary issue. They're going to continue to do quantitative easing and perhaps inflate the value of their currency even more. The gold market has been on an upwards tear recently, and again, whenever there's a lot of uncertainty, it's not surprising to see gold go higher. Silver has also had a little bit of a bounce as of recently. It kind of reacts with gold at them, in synchrony together, but at the same time, silver is kind of a minor metal these days. And I think there's much more upside in gold than there is in silver. I think people are still kind of skeptical of silver after seeing the major sell-offs it's had in the past. Usually when gold would go up perhaps 2%, silver would go up 5–10%. But these days, the silver market is not trading like that, not anymore. Those are the old days. These are the recent days. Gold and silver trade relatively in a similar percentage spread. Now, talking about the daily financial bulls, again, I'm very skeptical on the banks. Banks are exposed to rising commodity prices, and if you have rising commodity prices, granted, if you have to pay more money on gas, that means less money that can be saved up for a down payment to buy a house. If you can't get a down payment, you can't borrow money from the bank, and if you can't borrow money from the bank can't make money. It's as simple as that. Take care, folks, and I hope you guys have a wonderful trading day tomorrow.